Tonight's discussion focuses on an issue that has many investors alert and analyzing every development with precision. There is growing conversation about a potential February timeframe and what some observers describe as final banking signals. For certain Dinar watchers, this period could represent a meaningful stage for the Iraqi currency. Others interpret it as another structured step within a longer reform cycle. In this report, we will examine the situation in straightforward terms. We will assess internal financial reforms in Iraq, review what banking institutions may be communicating through policy adjustments, and explore why February 2026 has drawn heightened attention. Stay with me through the entire breakdown, because a closing perspective may reshape how you interpret the current landscape. There are subtle indicators circulating beneath the headlines. They are not dramatic announcements, but they carry weight for those paying attention. If you follow the Iraqi dinar and broader monetary shifts, this update deserves your focus. As we move through early 2026, Iraq continues advancing financial reforms that have been unfolding for years. Authorities remain concentrated on economic stabilization, diversification beyond oil revenue, and modernization of the banking infrastructure. These initiatives are strategic, not spontaneous. They form part of a comprehensive effort to reinforce the national currency and restore institutional credibility. Many investors concentrate narrowly on exchange rate speculation, yet the underlying framework, banking systems, regulatory controls, and digital payment expansion tells the deeper story. February has gained importance because multiple reform deadlines and banking adjustments converge within this window. When technical upgrades, compliance milestones, and fiscal implementation overlap, observers often describe it as an alignment phase. Alignment does not guarantee revaluation, but it can indicate structural readiness. If you value grounded analysis over rumor, take a moment right now to like this video, share it with others tracking the dinar, and subscribe for consistent, fact-based updates. In the next segment, we will examine the role of Iraq's central banking policies and what their recent actions may truly signal. And remember, what appears quiet on the surface often carries the strongest implications underneath. That a central element in the February discussion is the position and conduct of the Central Bank of Iraq. Over the past year, the institution has concentrated on tightening monetary discipline, containing inflationary pressure, and reducing volatility between the official exchange rate and the parallel market rate. These objectives are not cosmetic. They represent foundational monetary stabilization measures required before any significant currency policy adjustment could even be considered. One of the primary benchmarks observers monitor is the spread between the street rate and the official rate. Historically, a wide gap has reflected imbalance, speculation, and inconsistent liquidity management. Recent data suggests that the spread has narrowed compared to prior cycles. While not perfect, the improvement indicates stronger exchange control mechanisms and more effective oversight of currency auctions. Stability at this level is often interpreted as a prerequisite condition for broader monetary shifts. In addition, transparency measures have intensified. The central bank has strengthened compliance frameworks aligned with international anti-money laundering standards and cross-border reporting requirements. These enhancements are not merely administrative upgrades. They are signals to global financial counterparts that Iraq's banking environment is moving toward internationally recognized operational discipline. When policymakers emphasize compliance and monitoring, it usually reflects a focus on structural credibility rather than short-term optics. Liquidity management also plays a decisive role. Excess money supply can fuel inflation, while overly restrictive liquidity can slow growth. Recent updates indicate more balanced monetary control. Inflation, though not eliminated, appears more contained than in previous high-volatility periods. Controlled inflation creates safer conditions for policy recalibration. If you appreciate detailed breakdowns that separate evidence from speculation, pause here, like the video, and share it with others following these developments. Your engagement supports deeper analysis instead of rumor-driven narratives. In the next section, we will examine banking system modernization and why technical infrastructure upgrades may be fueling talk of final signals. And remember, readiness is often revealed through systems, not announcements. Beyond central bank policy, the modernization of Iraq's banking network is a major component of the February conversation. Both state-owned and private banks have been upgrading core banking software, strengthening internal compliance departments, and expanding electronic transaction capabilities. These developments may not generate dramatic headlines, but in monetary reform, infrastructure is everything. Without secure, transparent, and internationally compatible systems, broader financial integration is impossible. Several institutions have completed updated compliance audits and reporting certifications aligned with global banking standards. These certifications require detailed anti-money laundering controls, transaction monitoring systems, and standardized financial disclosures. When banks reach this level of operational readiness, they are better positioned to establish or expand correspondent relationships with foreign institutions. That connectivity is critical for handling large-scale currency settlements and cross-border flows efficiently. February has drawn attention because multiple technical upgrades were scheduled for completion at the start of 2026. When policy stability from a central bank aligns with operational readiness inside commercial banks, observers interpret that convergence as a potential window. Again, alignment does not equal immediate revaluation. It signals preparedness. Systems functioning properly, compliance frameworks verified, and reporting structures synchronized. Digital payment expansion is another layer in this transition. Iraq has accelerated efforts to reduce cash dependency by promoting electronic transfers across government services and private commerce. Greater digital penetration increases transaction traceability, reduces parallel market pressure, and strengthens regulatory oversight. When more financial activity moves through official channels, exchange stability becomes easier to manage. Public confidence also improves when banking systems appear modern and reliable. Deposit growth has gradually increased, suggesting more citizens are trusting formal institutions instead of holding physical currency. That behavioral shift strengthens liquidity control and deepens financial stability. If this level of structural detail is helpful, make sure you subscribe now and turn on notifications. Staying informed requires consistent monitoring, not emotional reaction. In the next segment, we will examine fiscal policy, energy revenues, and international partnerships, and how those external pillars influence the broader currency outlook. Keep watching, because the convergence of these factors is where the bigger picture becomes clearer. Fiscal policy and energy revenue remain central pillars in evaluating Iraq's monetary trajectory. The 2026 federal budget outlines allocations aimed at infrastructure development, private sector stimulation, and gradual diversification beyond crude exports. For years, heavy dependence on oil created vulnerability to global price swings. The current reform direction attempts to broaden revenue streams through agriculture, manufacturing, and technology initiatives. Diversification is not immediate, but incremental progress strengthens long-term currency backing. Oil income, however, still anchors financial stability. Production levels have remained relatively consistent, and export capacity has supported foreign currency inflows. Strong reserve positioning provides policy flexibility. When reserves are adequate, monetary authorities have greater capacity to defend exchange stability or manage transitional adjustments without triggering systemic shocks. February begins a practical implementation phase of several budget measures, which is why analysts are watching execution rather than just policy language. International engagement adds another dimension. Iraq continues expanding financial cooperation with regional trade partners and global institutions. Cross-border payment coordination, settlement efficiency improvements, and compliance harmonization all enhance credibility. As Iraq integrates more deeply into global trade corridors, predictable exchange management becomes increasingly important. Foreign counterparts require reliability before expanding exposure. Recent meetings between Iraqi financial officials and international banking representatives have centered on settlement systems, digital transfer reliability, and oversight protocols. While no public declarations reference currency adjustments, such coordination strengthens structural readiness. A country positioned within disciplined global financial networks faces lower systemic risk during policy transitions. Governance reforms also influence investor perception. Anti-corruption initiatives and improved public fund monitoring increase transparency. External stakeholders often evaluate governance standards as closely as monetary indicators. When oversight mechanisms strengthen, long-term confidence improves. If you value balanced evaluation instead of speculation, This is the moment to share the video and drop your perspective in the comments. Engagement builds a community focused on analysis, not hype. In the final segment, we will bring every element together: reserves, liquidity, reform timing, and global context, to assess whether February represents culmination or continuation. Stay with me, because the conclusion requires nuance. When we step back and assess the full framework, February 2026 stands out not because of a single dramatic announcement, but because multiple reform tracks are converging at the same time. Monetary stabilization from the Central Bank of Iraq, banking system modernization, reserve strength supported by steady energy revenue, digital payment expansion, and tighter compliance alignment with international standards are all progressing in parallel. Convergence creates attention, but attention is not confirmation. Liquidity indicators appear more balanced than in previous high volatility periods. Inflation pressures, while still monitored, are more contained. Deposit growth suggests gradual domestic banking confidence. Cross-border settlement systems are improving. Budget execution is moving from planning into implementation. Each of these variables independently supports stability. Together, they form a stronger structural base than Iraq has demonstrated in many past cycles. However, responsible analysis requires discipline. Currency revaluation is never triggered by optimism alone. It depends on macroeconomic durability, geopolitical context, oil market conditions, reserve sufficiency, and timing within global financial markets. External pressures, from trade shifts to regional tensions, can influence policy pacing. Any adjustment would likely be calculated, phased, and strategically timed rather than abrupt. The phrase "final bank signals" should therefore be interpreted carefully. It may indicate that technical preparation is reaching maturity, systems aligned, compliance framework certified, reserves solid, liquidity controlled. It does not automatically mean an immediate rate shift. Readiness and action are related but distinct stages. For investors, the strategic approach remains the same. Monitor measurable indicators, evaluate policy language objectively, and avoid emotional extremes. Watch the exchange spread, observe inflation data, track reserve updates. Follow implementation milestones within the 2026 budget. Patterns matter more than rumors. If this comprehensive breakdown clarified the landscape, make sure you like the video, share it with other informed investors, and subscribe for continued analysis grounded in evidence. Also leave your view in the comments. Do you see February as culmination or continuation? The weeks ahead will provide additional clarity. Until then, stay patient, stay analytical, and keep watching the signals that truly matter. Because sometimes a quiet convergence of reform speaks louder than any headline.